We are going to go over Crowdstrike Holdings, ticker symbol CRWD. Year to date, up 60.95% over the course of 1 year, down 2.87%. So we're going to we're going to go over the balance sheet, the 8K, the most recent earnings statement. Then we're going to go over some valuations to find a fair market and roughly an acceptable buy price on Crowdstrike Holdings. And then finally, we'll take a peek at the stock chart and see where price action might be headed. We begin with the income statement. Year over year, revenue's up 27% from 535 to 731. Our cost of revenue is 25% of our total revenue and is up just a bit, up to 183 million. So that gives us a gross profit, which is 75% of our total revenue. It gives us a 549 gross profit. When we come down here, we have all of our operating expenses, which soaks up more than our gross profit with a number of 564, which gives us a negative loss from operations of 15.3 million. Down here, we have interest income, which now turns our income from a loss to a positive of $13 million. After income taxes, now gives us a positive 800 or $8.5 million. Over the course of the last 6 months, which is the number that will be used on the cash flows, is $8.9 million positive net income. We can see we hit a positive earnings per share. Also, we can see our share count increased by 10 million or 4%. Our interest income, mostly, as we'll see shortly, is not from long-term or short-term investments. It's actually from our accounts receivable. Because these accounts receivable are like credit cards type deal, where they probably have an interest attached to them. So their customers are, pay monthly payments. They now get to charge a bit of a credit. So we're probably making money, a certain percent off of this, well, which would have been this $600 million where we made 36 million or on income, on interest. So now we're on the balance sheet. We can see we went from 2.5, let's call it, to 3.2 billion. There's a big jump in cash. We want to know why. Why was there so much cash added? Was it from, more stock-based comp, or was it just from selling equipment? What was it from? Because we know it wasn't from net income, because that was only positive 9 mil. So as we come down, keep note of this is $250,000, the short-term investment that they had of $250 million. That'll show up on the cash flow statement. So accounts receivable, we went from 628 down to 539, so their customers are paying their bills, and we'll see this 86 million roughly show up on the cash flow statement also. Plant, property, equipment. Looks like we added more plant, property, and equipment. An increase in that is typically always a good thing, because then that means we can potentially see more revenues coming out of this company. We have $510 million of intangibles. We have 430 of goodwill and 779 of just intangible assets. I like to eliminate those. Those are basically worthless and gives us a $5 billion total asset. So overall, our cash increased by basically $500 million, and we know a good chunk of that just came from from the cash increase. Deferred revenues, which we can see is 1.9 and 600 for a total of 2.5 billion of deferred revenues for only 1.1 billion worth of total debt. Because these deferred revs, if you don't know, are basically unearned revenue. A little further down, so our shareholder equity grew from 1.5 to 1.9. The only downside to that is we did increase our share count by 10 million. Net income from our income statement from the 6 month side is 897. Down here we have a big $113 million increase from deferred contract acquisitions. However, down here we have a negative 122 from deferred contract costs. So then those two numbers basically offset themselves, which gives us about a $9 million loss. Stock-based comp was one of the biggest numbers here. We can see was 295 million. And then down here we have our deferred revs of 152 million, which was about our increase in the last 6 months. We have about 152 million there. Gives us a full net cash provided by operating activities of 545. And a good portion of that is from stock-based comp. Our CapEx for this last 6 months was 103 million. So we take our 405 million, which is our net cash provided by operating activities, minus our CapEx of 103, gives us a free cash flow of $442 or 442 million. And over the course of the last 6 months, 984 annualized. A little further down on that balance sheet, we had that $250 million short-term investment right here. They sold. They sold that short-term investment. For what reason? I don't know. They've got plenty of cash unless they got some sort of big project they got coming up and they think they need to free up to have as much cash on the balance sheet as they need. Um, Not sure why. I mean, you got $3.2 billion of cash. There's plenty of cash. You are turning positive free cash flow, not significantly once we break down the free cash flows a little bit. Um, just a question mark there. Gotta wonder why. So that overall net cash used slash provided by investing activities was positive 108 million because of that. We are still doing issuing more shares, gives us another $58 million increase in cash provided by financing activities. And then all in all, you add 58 plus 108 plus 54 or 545 gives you a total net cash increase of 712 million. That 712 gets added to two cash and cash equivalents at the beginning of the period, gets added to this. Now they're at $3.169 billion of cash. So real quick breakdown of the cash flows here. Eventually this can't be sustainable. Investors are going to catch on. They're going to continue to get more and more diluted. So this is something that we don't want to keep seeing. So we want to see that go, start shrinking or yeah, I mean we want to see it start to go down, right? Or their stock-based comp expense. So if we can see that go down, but right now it is what it is. So we have 245 million. So if we take out 295, we want to calculate in more sustainable stuff. We want to actually calculate in actual profits from the company, not just more borrowing in a sense, right? So that gives us 245. And then down here, this also is a one-time thing. So we eliminate that. That gives us a negative 140 from investing activities, which we purchased. We want to see this. You want to see more plant, property, and equipment being bought, so that way we can increase their revenues. And same thing with probably their software, make their software better. And do strategic investments, and maybe not purchase intangibles because that doesn't do us any good, but do these things, focus on those things so that way you can grow your business and make your shareholders wealthy, right? That's what we do. That's why we're here. So overall, we're negative 140, and then we want to try and see this also eliminate. We don't want to see them wanting to borrow more money. They don't need to. I mean, not like this is a big expense. It's 58 million out of 303.2 billion. It's nominal. But let's pretend that should be a zero. So overall, the increase in cash and cash equivalents based on relatively true operating activities is only 115 million. So you went from 712 to 115 million, in my opinion, is what is the real increase in cash from operating activities, not just from some other financed activities that they did. So I'll hop over here to the valuation spreadsheet. We have some company statistics here. We can see our market cap. Company does not pay a dividend. Financial efficiency. So their current return on equity is negative 6%. Return on invested capital is negative 8.6%. Gross margin, this should be green, it's 74%, which we saw it was 75, but this is trailing 12 months, so 74% for an average in the last 12 months. Operating margin in the last 12 months was -6. Profit margin in the last 12 months was basically, it was -3.5. Our change in share change year over year was 4%, which we saw. Analysts forecast have a price target of $181. They're forecasting revenue growth of 30% for the next 5 years for an average. Forward revenue growth projected is 28.7% in 24, 25% in 25, and 36% in 26. So analysts are projecting this to continue to grow at basically a 30% grower, like we just saw up at the top. Earnings per share growing 29, 30, and then 40%. So good future growth on this company. Again, if they can just contain their operating expenses and keep those steadily, like shrink them or just maintain them and not grow them, I think this company will have no problem turning positive in the next coming quarters. So over here, return on invested capital, we know is 9.6%. Because we have a negative earnings per share yet over the last 12 months, a lot of these valuations will be invalid. So our Peter Lynch valuation, invalid. Our multiples comparison, same thing. We can see some other multiples here. We can get an idea of their PEs, their EPSs over here as well. That gives us because we're a negative $26 per share. But the multiples PE average is 66. The manual PE we can do. We have our market cap, our cash equivalents, our debt, which really is, 1.1 billion, not 3.6. A cash from operations is 1 billion. So if we actually change this to 1.1 billion, that doesn't change us too much. It only takes off 2 years before this company equals its market cap. Because what matters the most is this cash from operations. If they can increase their cash from operations, which at their current growth they should be able to do, then that's what's going to make this multiple jump significantly. So if we can see a jump in cash from operations, this will make this multiple look a lot better. Which, as a growth company, obviously, we want to see this grow. Next up, price to book. Currently sitting at 28.5. The 5-year average is about 25. Our forward-looking peg is 1.58, so fairly valued looking forward. Our grams valuation, again, we have a negative earnings per share, so this is another invalid valuation method. Weighted average cost of capital, 8%. Perpetual growth rate, 2.5. 40% free cash flow growth rate looking forward. We can see here our cash from operations are growing year over year. Our capital expenditures are also, but not as quickly. Gives us a free cash flow up here year over year. And then we do 40% off of 702. And then our free cash flow continues, our future free cash flow continues to look like that. All in all, we have our cash and marketable securities here, and then gives us a DCF price of $279 per share. Rule 72. So I have to manipulate this one a little bit. I want to try and get 2 valuations. I feel like this is the best one to do for a second valuation method. So the earnings per share, I typed in 2.8 because that is the forward looking in the next 12 months earnings per share. Forward PE in the next 12 months is 58, which gives and then the lowest 2 growth rates, we have 29.5. 29.5 goes into 72, 2.4 times. 4 goes into 10 years, 2.4 goes into 10 years 4 times. So we're going to double our EPS 4 times over, which gives us a future multiple of 45. Now, it gives us a fair value of $664. So I don't believe this is a sustainable earnings per share for the next, 10 years time roughly. We want this, I put 10 in. I feel like that's a very, very conservative, very fair earnings per share growth rate, which then gives us a future EPS of, we're going to go with 11. So at 11, we get a fair value of $162 and 30% margin of safety of $114 per share. And if you think 20 is more the number, then we can type 20 in. So we're looking at just shy of a 3, gives us a 23 for future EPS. So now you can see, you can see these numbers. You can kind of get a better idea of maybe a range. So 10%, doing 11, that's my number. 162 over here, since we've only got the two valuations to go off of, the DCF and then this Rule 72 or fair value, gives us an average price of $220 per share or $155 acceptable buy price. So overall, on the financial side of things here, the good, steady growth. They're beginning to turn positive and are forecasted to turn positive for their trailing 12 months earnings per share. They added cash to their assets, more cash to use to increase their revenues. They just got to put that cash to work instead of sitting on $3 billion. Reasonable amount of debt, and great portion of it is deferred revs, as we saw that 2.5 billion of their debt was deferred revenues, which only really leaves them with 1.1 billion dollars in debt, and they've got 3 billion dollars in cash. So they've got, and that's total debt. I mean, that's really good. That's solid. Bad return on equity and return on invested capital are both negative, which we're kind of going over that. They're just sitting on the capital. They're not growing the capital for us right now. Only reason for positive net income from interest, even though it's a growth company, it's typical to see share dilution, but it's just something always to be aware of. They sold their short-term asset for the same price they bought it, that $250 million short-term asset or short-term investment of whatever, and they sold it immediately for some reason. Just something a little bit, again, a question mark in my eyes. Not like it's a big number, but it is just, I find it different. I find it unusual. CRWD, we are on the weekly chart. We can see we had this big downtrend. We have now broken this downtrend and now up and back into an uptrend. We are now sitting at what I would consider some definite resistance points, but we're kind of making a little bit of a channel here, a wedge in the shorter term, to where maybe this is the time this breaks out or it rejects. Based on the current market, or the way the market's trading, I think it's going to get rejected here, potentially pull back and then resume higher. But if the market leading up until CPI next week, if the market pulls back in anticipation of that, and then maybe CPI is good and we resume higher, I think CrowdStrike's going to kind of follow that price action. But if it decides to say, nope, we don't care about that, then we might resume higher here. And based on analysts have this price target up right in this range of $182. And what we just saw was $224, which is up in this range, which both are relatively reasonable. We're in that 181 to 224 range. And then our acceptable buy price was $155 per share, which if it does pull back, might be for a good buying opportunity. If I'm right and it does pull back with the broader of the market, then we might see a resumption higher here and might be a good buying opportunity on CrowdStrike Holdings. There's no shortage of growth. Company's growing very steadily, very rapidly. Financials overall look pretty solid. Again, personally, I would like to see them use that cash for more than just, money in the bank. They've clearly got the customers. They got the deferred revs there that can get carried over to the cash flow statement. So yeah, I see a lot of good things on their balance sheet and their income statement and their cash flows overall. I think it's a pretty solid company, and I think it just has a little bit of work to do in terms of putting their cash to work and reducing their cap or their operating expenses. If they can use that cash, it's like here's it. If they can use the cash and put the cash to work, and if they can somehow stabilize or reduce their operating expenses, create some shorter term investment opportunities, I think those three things will turn this company around, like not just around, but increase this company's potential So that's Crowdstrike Holdings. If you found value in this video, drop a like, subscribe. We will be back later with some more stock valuations.